Hi, this is Scott McLeod with Brown Financial Advisory. Since we've seen so much volatility in the market over the last few days, I thought it might be a good idea just to touch base with you and kind of describe what's happening and give you some context with regards to what you should expect in the portfolio. So we're going to talk a little bit about tariffs, we're going to talk a little bit about the volatility, and I look forward to sharing some ideas with you. So let's get started. The first thing is this is me and some disclosures and our agenda. So to get started, I want to share with you, first of all, that we're going to talk about the nature of volatility, the frequency of corrections, and what you should expect on a day-by-day basis in the stock market. The second thing we'll talk about are tariffs and stagflation. So stagflation is defined as inflation rates that are rising while the economy is contracting. And with the discussion of tariffs, we've seen a number of economists who have described stagflation as a potential outcome from for the U.S. economy. So I'm curious how that impacts the portfolio and what might happen in the stock market, and I'm anxious to share with you what I found. And then the last thing is the cost of timing the market. So it's a natural inclination to try to get away from the volatility when it occurs, but it's very important for you to remember that volatility is a normal part of the process. So I'll describe for you what that looks like and just exactly what you should do in the face of volatility. So the first thing is the nature of volatility. What's the frequency of corrections? As you can see from this chart in the first column, normal market declines of 5% or more occur very frequently. In fact, you can see they occur almost twice a year, so every 6 months on average. So volatility is really just a normal process in the stock market. I say often it goes up and down all the time. It just goes up more than it goes down, and that's how we win. And in a more technical sense, that's described as the equity risk premium. The equity risk premium is how we're compensated for taking on that extra volatility. We could park the money in a CD, but our returns won't be as high. But because we're willing to take some volatility, our returns are much higher. So what about bigger declines? So recently this year, we've seen the stock market decline from a high recently of almost 5% down to now a negative 4.5% or so. So it's almost a full 10% correction as a correction is defined. Well, 10% corrections, as you can see from the chart, occur about once every 18 months. So it's not unusual for us to see 10% declines in the market. In fact, they come around really quite frequently. So when we see volatility like this, it shouldn't cause us to panic. What often accompanies this type of volatility, though, is the news cycle and the media blowing it up into something that it isn't. So we've seen some things like the tariffs, like what economists are describing as potential trade wars, and you're seeing the talking heads talk about the negative implications. Those things tend to really push into recessions and so forth, but the volatility itself is absolutely normal. We're not really out of the realm of a normal level of volatility for the simple reason that we haven't seen a really good correction in over 18 months, so it's about time for that type of volatility. Now the question is, will we go on into a 15% decline? I wouldn't be surprised by a 15% decline, if only for the reason that those stocks that are really driving a lot of the decline right now were very expensive at the beginning of the year. So we could slide in to a 15% decline, and that occurs about every 3 years on average. So we might be a little premature on that, but we also grew really fast the last 2 years, so maybe it's not unusual to think that it might be a possibility. But every 3 years or so, you should be expecting a decline that's around the 15% range. That's what has happened on average since 1954. So if we see that kind of volatility, no reason to panic. That's just normal course of doing business. And then the last one is 20% declines. So 20% declines really only occur about every 6 years on average. Every 6 years means that we've really probably experienced either a recession or some catastrophic economic shock. They don't come around just for no good reason. And so we really shouldn't expect a 20% decline this time around, but who knows? It could happen this time around. We haven't seen a 20% decline in a number of years. And so it could be about time for a good decline like that. The point is, volatility is a normal course of doing business. We're compensated for that volatility by the equity of risk premium, and by sticking through that volatility, we make higher returns than we would if we were in fixed rate securities, and that's the primary takeaway. Now, the next thing that I'd like to share with you is some interesting information about stagflation. So tariffs, in one way or the other, some people think they're good. The Trump administration thinks it might be a good way to reposition the U.S. In the global economy, and also that some economists think that it might drive inflation. So we might end up in this situation where we see a recessionary environment, but growing prices, rising prices in the form of inflation, and that's how you would describe stagflation. But it's not as bad as you might think, and history spells something that's a little bit different. So this chart describes 4 different environments. So normally we live in the top right quadrant. So normally we see growth in the economy and inflation continuing to push prices up. But now we see a risk that we might fall into the quadrant below that, that is a stagflationary quadrant, where we actually see the change in prices going up, but the growth rate's coming down. And that's a scary scenario for a lot of people, because they think, well, my goodness, we're seeing higher prices but lower growth. That has to be terrible for the economy. And I wouldn't describe stagflation as a good idea. But what I would say is that the stock market has reacted somewhat differently. So since 1930, we've seen 12 examples of stagflation in the United States, and 9 of those examples have resulted in a positive stock market, positive returns, even after inflation in the market, that have averaged 16.4%. So while it's a little bit scary, I mean, that, you're looking at 3 that were not that way, but the other 9 actually resulted in a positive stock market. So the takeaway from this is that, yes, there is some scary economic data out there. Yes, they're talking about now the potential for recession. Yes, they're talking about for higher inflation, etc. But do not get too hung up on those details, because the market can tend to run right through that and may grow just the same even if we weren't under that duress. So be mindful that the market can operate, if the prices are right, the market can operate independently of those factors that we might otherwise consider terrible, and the market might continue to grow just as it has in the past. Since 1930, 9 out of 12 have actually produced a positive return. So the last thing I'll share with you is that the cost of timing the market. So our natural reaction whenever there's a market decline like this is to get away from it. We don't like the feeling, certainly I don't, but I know when the market's going down and we're watching the portfolio slide, it's scary stuff. And our first inclination is, let's get away from that scary stuff, especially when the media is blowing it so out of proportion that we're hearing every little tidbit of what could potentially be bad news, whether it actually is or not. We're hearing all the potential bad news. So I would share with you that there's a really good reason that we don't do that in the portfolio, and it's very simple. It's easy to pull the trigger to get out of the market. It's nearly impossible to pull the trigger to get back in. And the reason for that is that when you're out of the market during periods of volatility, you're waiting for a sign that there's an all clear. And the fact of the matter is the market starts moving in the opposite direction, starts going back up again long before the all clear sign comes. So what happens is just very basic math. If you are in the Russell 3000 index, which is kind of a total market index for the US, since 2000 through 2024, 25-year time frame, and all you did was put $1,000 in at the beginning of that 25 years and left it, that $1,000 would be worth $6,000 now. But let's just say, for example, one of the many periods of volatility that we've already described, they come around so frequently, you decided to get out of the market and you missed 1 week that just happened to be the best week of recovery in that 25-year time frame. 1 week out of 25 years, it would lop off 18% of your ending value. 18% of the value that you've accumulated would be gone because you missed 1 week. So let's stretch that out even a little bit further. Let's say it's especially scary and you decided to stay out a month, but it just happened to be in that 25-year time frame the best month to be back in the market. No way to know because there are no economic indicators, but it grew faster than all the other months. it would have resulted in a 20% reduction in your final value. And then lastly, just to think about a 3-month or a 6-month time frame. A 3-month, it was really scary. I can remember 2008 and 2009, a really scary time frame. But what if you missed that quarter that just happened to be the best quarter in that 25-year time frame because you just couldn't stand the volatility and you got out at just the wrong time and you missed that quarter? It would have lopped off 30% of your return. So keep expanding that and just say, what happens if I'm out of the market at exactly the wrong time? We're down 10%, but there's nothing to say it won't go further. There's also nothing to say that it won't turn around tomorrow because Donald Trump decides tariffs are a bad idea after all, and who knows? But the point is if you're out during those periods of recovery, it will surely destroy your returns. And so what we do is we don't try to outsmart the market. We ride the waves just like a surfer rides an ocean wave. We know that it's going to be good. Sometimes it's going to be bumpy. We do the best with what we have, and we rebalance during those periods of volatility. We do tax loss harvesting. We do Roth conversions, etc. That's how you win, not by trying to be in and out of the market over time, because there are no statistical markers to tell you when to do that. What we do is we do all the other things to make lemonade out of the lemons that the market gives us, and it's given us lemons right now, so we may have that opportunity soon. So the takeaway is, number one, volatility is normal. You should expect volatility. Number two, the markets can surprise you even when you think something like stagflation would be so horrendous. You might be surprised that the market actually outperformed 9 out of 12 times since 1930 every time we hit stagflation. And then the final thing is, don't be tempted to pull money from the market when you see volatility or when you hear these news stories about how bad it could possibly be. It's the number one way to destroy your performance over time, because there's no way to know when to get back in. I thank you very much for your time. I hope you found this helpful. I really hope that you'll let us know if you have any questions, or visit our website at brownfinancialadvisory.com, and I'll look forward to seeing you soon.